Imagine walking into Tractor Supply or Walmart on a Tuesday morning in early 2026. You re-looking for a replacement part, but instead of a price tag, you see an empty shelf. Or worse, the price has quadrupled, and a small sign says, "Backordered, expected in 6 months." You ask the manager what's happening. He tells you it's not a shipping problem. The factories simply can't get the metal to make the part. This isn't fiction. It's the mathematical certainty of what's coming. While the news obsesses over politics, a much bigger story is unfolding. We're not in a trade war. We're in a resource war. And the weapon isn't a missile, it's the periodic table. China has quietly gone from being the world's factory to the world's warehouse, hoarding the very building blocks of modern life. The inflation coming isn't just about printed money. It's scarcity inflation. You can't print your way out of a physical shortage. Stay with me. They have stopped recycling their surplus into paper assets like bonds. Instead, they are converting their wealth into hard, physical assets. Let's look at the numbers. In the last 18 months alone, the People's Bank of China has purchased more gold than at any other time in its history. But gold is just the headline grabber. The real story is in the industrial metals. State-owned enterprises are aggressively buying up copper mines in Africa and lithium deposits in South America. They are securing long-term contracts for cobalt and nickel. Why does this matter to you? Because these are not just shiny rocks. These are the essential ingredients for everything from your pickup truck to your toaster. Think of it this way. For decades, we relied on China to bake us the cake. Now, they have decided to buy up all the flour, sugar, and eggs. They don't care about selling us the cake anymore. They care about controlling the ingredients. If you control the ingredients, you don't just control the price. You control who gets to eat. Let me give you a concrete example of this physical over-paper mentality. Right now, if you look at the price of silver, there is something very strange happening. Silver trading in Shanghai is often 10% to 15% more expensive than silver trading in New York or London. This is called the Shanghai premium. In a normal market, traders would just buy low in New York and sell high in Shanghai until the price is matched. But that is not happening. Why? Because the Shanghai market demands physical delivery of the metal. They don't want a paper contract that says they own silver. They want the actual bars in their vaults. The West is trading paper promises. The East is draining the physical inventory. And when you apply this dynamic to every critical commodity on Earth, you start to see the trap we are in. We have financialized our economy. We have trillions of dollars in paper wealth. But paper cannot build a bridge. Paper cannot fertilize a crop. And paper cannot cure an infection. When the supply of physical goods tightens, the value of that paper wealth is going to evaporate faster than you can imagine. This is not just an economic shift, it is a transfer of leverage. And the entity holding the leverage is the one holding the physical stuff. The direct impact, farmers and patients. Now, let's bring this down from global geopolitics to your kitchen table, because this is where the pain is going to be felt most acutely. There are two sectors that are absolutely critical to survival, and they are both in the crosshairs of this resource war: agriculture and healthcare. Let's start with the farmers. If you are in farming, or if you just like to eat affordable food, you need to listen to this. Modern agriculture is built on three things: nitrogen, phosphorus, and potassium. China is the world's largest exporter of phosphate fertilizers, or at least they used to be. Starting in late 2024 and tightening through 2025, Beijing has imposed strict export quotas on phosphate and urea. They are keeping it at home to ensure their own food security. The result for the American farmer: skyrocketing input costs. When fertilizer prices double, farmers have two choices. They either plant less, which leads to shortages, or they pass that cost on to you at the grocery store. We are already seeing this pressure build in the futures markets, but it gets worse. Let's talk about machinery. Everyone knows John Deere and Caterpillar are American icons. But open up the hood of a modern tractor. It is packed with sensors, chips, and electric motors. Those components rely heavily on rare earth magnets and specific alloys. In October 2025, China rolled out new regulations requiring detailed reporting on how rare earth exports are used in the West. This is a soft blockade. It introduces delays, uncertainty, and massive compliance costs. So in 2026, when a sensor fails on your combine harvester during harvest season, you might not be able to get the part. A $500,000 machine could be rendered useless by a missing $50 component. That is the fragility of our supply chain. Now, let's look at healthcare. This is the one that truly keeps me up at night. We rely on China for the vast majority of our active pharmaceutical ingredients, or APIs. These are the actual chemicals that make drugs work. We are talking about basic antibiotics like amoxicillin. We are talking about ibuprofen. We are talking about hydrocortisone. Even the contrast dye used in MRI scans relies on supply chains that run through China. If tensions escalate, or if China simply decides to prioritize their domestic stockpiles, American pharmacies will face immediate shortages. Imagine being a retiree with a chronic condition. You go to refill your prescription and the pharmacist tells you they are out. Not because of insurance issues, but because the raw materials simply did not arrive. This is a national security vulnerability that we have ignored for too long in the name of efficiency and low prices. We traded our resilience for cheap goods. And now the bill is coming due. The inflation we are facing in 2026 will not just be about things costing more dollars. It will be about availability. It will be about the return of waiting lists. It will be about rationing. This is a reality that most Americans have not faced since the 1940s, and frankly, we are not culturally prepared for it. The wealth trap: paper versus physical. So, what does this mean for your money? If you are like most people over 55, you have spent a lifetime saving. You probably have a 401k or an IRA. You have been told to follow the classic 60-40th rule. 60% stocks, 40% bonds. That strategy worked beautifully for 40 years because inflation was low and resources were cheap. But that era is over. We are entering a period of structural inflation. This is different from cyclical inflation. Cyclical inflation goes up and down with the business cycle. Structural inflation is sticky. It stays high because the cost of doing business has permanently increased. In this environment, long-term bonds are a dangerous place to be. If inflation runs at 5% or 6% because of resource scarcity, a bond paying you 4% is actually losing you purchasing power every single year. You are safely losing money. And what about stocks? Many companies in the S&P 500 are heavily dependent on global supply chains. If Apple cannot get enough metal for iPhones, or if Ford cannot get batteries for EVs, their earnings will collapse. The stock market is currently priced for perfection. It is priced assuming that global trade continues as normal. It is not priced for a resource war. This is why we see smart money moving. They are moving out of paper assets and into hard assets. Hard assets are things you can touch: land, energy, precious metals, commodities. These are the things that maintain value when the currency is being debased and supply chains are breaking. There is another factor compounding this risk: Japan. We don't have time to go deep into the yen carry trade today. But here is the simple version. For years, Japan kept interest rates at zero. Investors borrowed cheap yen to buy American stocks and bonds. Now Japan is being forced to raise rates to save their own currency. That cheap money spigot is turning off. This removes a massive layer of artificial support from U.S. markets right at the moment we can least afford it. So you have a double whammy: rising costs due to resource scarcity, and falling liquidity due to changes in global monetary policy. It is a perfect storm for the unprepared investor. But I want to pause here and ask you a question. This is something we need to discuss as a community. Do you believe we should accept higher prices to bring manufacturing back home? Are you willing to pay 20% or 30% more for a made-in-USA tractor or toaster if it means we are not dependent on China? Or is the addiction to cheap imports too hard to break? Let me know your honest thoughts in the comments below, because this is the choice we are facing. We can have cheap goods and vulnerability, or we can have expensive goods and security. We cannot have both anymore. The protection plan and conclusion. I know this is heavy. It is not the kind of feel-good news you usually get on YouTube. But I share this because I believe knowledge is the only antidote to fear. Panic is what happens when you are surprised. Preparation is what happens when you are informed. So, what can you do this week? Here is a practical checklist. First, look at your personal supply chain. If you are a farmer or a small business owner, do an audit of your critical equipment. What are the wear and tear parts that you know you will need in the next 12 months? Filters, belts, pumps, electronic sensors. Buy them now. Do not wait for them to break. Create your own personal inventory. Treat these spare parts as an investment. They will likely outperform the S&P 500 next year just on price increases alone. Second, think about your medicine cabinet. I am not telling you to hoard, but I am telling you to be resilient. Talk to your doctor about getting a 90-day supply of critical daily medications instead of a 30-day supply. Look into legal, safe ways to have a backup of essential antibiotics. There are reputable services that provide emergency medical kits for exactly this scenario. Third, reconsider your asset allocation. Sit down with your financial advisor and ask a hard question. How does this portfolio perform in a decade of high inflation and resource scarcity? If the answer is, we will just ride it out, you might need a new advisor. You need exposure to things that benefit from inflation. Energy companies. Domestic producers. Physical precious metals. Having 5% or 10% of your wealth in physical gold or silver is insurance. It is not a speculation. It is a hedge against the currency losing value. And finally, support local production. Build relationships with local farmers and producers in your community. The shorter the supply chain between you and your food, the safer you are. We are heading into choppy waters. The era of easy abundance is pausing. We are entering an era of grit and resilience. But Americans have always been good at grit. We just need to wake up and realize the game has changed. The made-in-China price shock is coming. But if you take these steps, you won't be a victim of it. You will be prepared. If you are concerned about your 401k and want to understand the specifics of moving from paper assets to hard assets, you need to see my next video. I'm going to break down 7 unprintable assets you need. Before the 2026 crisis hits, these are assets that the government cannot inflate away and China cannot cut off. Make sure you are subscribed and have notifications turned on so you don't miss that deep dive. Stay safe out there. Stay prepared. And remember, the best time to fix the roof is while the sun is still shining. I'll see you in the next video.